You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast.
We're doing something a little different today, kicking off a brand new 100-part series.
That's right. We're going to walk through macro fundamentals right from the ground up, really for the absolute beginner.
So if you're new to economics, maybe trading or policy, this series is definitely built for you.
This is Deep Dive 1, mapping the financial world, the four streams of global capital. Now, most people, I think, see the market as just chaos, maybe noise, or some building somewhere.
Right, like the stock exchange floor. But we're going to show you how to see it differently. Think of it as a single rational circulatory system.
Yep.
And it's built entirely on human belief.
Yeah, that belief part is key.
It really is. In a world where, everything's digital and volatility feels, constant. Understanding this invisible architecture of risk and opportunity. It's not optional anymore.
So today, you'll learn how the four big global capital streams, that's FX, equities, fixed income, and commodities, how they interact. And maybe more importantly, how you can spot opportunities in that gap between the cold charts and, messy human psychology.
Let's unpack it.
Okay, so let's start right at the beginning, the most fundamental concept. If we zoom way out, what is the market actually selling?
It's a great question. And the simplest way we've found to put it is this. Price is just belief agreed upon for a moment.
It's just belief. It's agreed upon for a moment. I like that.
It's crucial because it takes the place out of it immediately. Forget the movie image of traders yelling in a pit. That world, it's gone, dissolved into code.
Right.
The market isn't really a location now. It's like a living record, a global ledger of collective human belief.
And here's the thing for you, the listener, the learner.
Yeah.
You need to realize you are already inside it.
Absolutely.
Every time you make a mortgage payment, swipe a credit card, take out a loan, you're participating. You're part of this huge 24-hour global thing that moves the world's wealth around.
It's flowing constantly through data centers, bouncing off satellite. There are no borders.
Yeah.
When you log into your online bank or your trading app, you are effectively standing on the exact same invisible floor as the biggest hedge funds, the central banks, everyone.
And that's the real tension here, isn't it? Access is universal now. Everyone's on the same field. But understanding how it all connects, how the plumbing works, that's not universal at all. You've got the access. Now we need to help you build the insight.
And to build that insight, you've got to cut through the noise. So we break the market down into four sort of essential streams. Think of it like a river system for global capital flow.
Okay.
Foreign exchange, equities, fixed income, and commodities. Just those four.
And what I find fascinating is how each stream seems to reflect a really core human instinct. That feels like the key to interpreting them.
That's a great way to put it.
So foreign exchange, that's driven by necessity. Equities, well, that's ambition. Fixed income is about stability. And commodities, that's pure survival.
Exactly. If you can track those four deep instincts, you're essentially tracking the movement of trillions of dollars.
Wow. Okay.
So let's start with the base layer. Stream 1, foreign exchange, FX. This is literally where money trades hands.
Right. Euros for dollars, yen for pounds.
Precisely. And the scale is just, it's hard to grasp. We're talking nearly $7 trillion changing hands every single day.
7 trillion daily.
Daily. It's the planet's biggest, fastest, most fundamental market. A nonstop torrent.
And you called it the stream of necessity. Why necessity?
Because you have to exchange currency just to play in the global game. Think about it. If you're a tourist buying souvenirs, you need local currency.
Sure.
If you're Apple buying components from Taiwan, you need to pay in their currency. It's the absolute foundation for global value flow. You can't avoid it.
Okay, that makes sense. It's essential plumbing.
And because it's foundational, FX is like the world's financial first responder. Any major shift, FX reacts instantly. Central banks hike rates.
Currencies move.
Immediately. Global mood gets optimistic. Stocks rally. You see what they call risk currencies, like the Aussie dollar, the Canadian dollar, they strengthen.
But hang on. If this market is full of giant central banks, huge corporations, and these super fast algorithms making billions of trades, I mean, what chance does an individual learner, a retail trader, actually have? What's the edge?
That's the million-dollar question, isn't it? The edge is agility and interpretation.
Okay.
Machines are built for finding tiny efficiencies. Algorithms calculate probabilities at lightning speed. But humans, we process meaning and emotion. Algorithms calculate risk. but humans panic.
Ah, I see. So the edge is in that gap.
Exactly. That small window when mass psychology, fear, or greed causes a sudden sharp move before the machines can fully recalibrate and smooth it out, that's where a nimble individual can potentially find an edge.
And the classic example has to be the British pound after the Brexit vote.
Perfect example. The pound collapsed almost instantly, not because some algorithm ran a new calculation.
No, it was belief.
It was a mass repricing of trillions in global capital, all based on a sudden, collective shift in belief about the UK's economic future outside the EU. FX measures that change in belief, that psychology, in real time.
Okay, so FX is the foundation, the first responder driven by necessity. What's next?
Well, if FX sets the basic rhythm, stream 2, equity stocks sets the melody, this is where belief becomes actual ownership. This is the stream of ambition.
Ambition, because when you buy a stock, say Apple or Tesla, you're not just buying a share certificate, you're buying into an idea, right?
Precisely. You're making a bet on that company's future growth, its future success, its ambition, literally monetized.
Right.
And it's useful to know equities operate on two levels. There's the primary market, that's IPOs, initial public offerings, where companies first sell shares to raise capital.
Right.
And then there's the secondary market. That's where you and I and everyone else trade those shares day to day, exchanging ownership, redistributing wealth, and risk.
And equities are probably the best gauge of overall market mood or sentiment, that risk-on, risk-off thing everyone talks about.
Absolutely. They really drive that rhythm. When investors feel optimistic, confident about the future, capital flows into stocks, chasing growth, that's risk-on.
But when storm clouds gather, maybe geopolitical tensions or inflation worries spike?
And then fear takes over. Liquidity flees the stock market. People sell shares and look for safer places to park their money. That's risk-off.
And this creates knock-on effects everywhere else.
Huge ripple effects.
Yeah.
A big stock market rally. That tends to strengthen those risk currencies we mentioned in the FX market.
Right, the Aussie dollar, etc.
Yeah. But a sharp equity sell-off, that pushes money into perceived safe havens, like government bonds or gold. Everything's connected.
So the key insight here, go back to what you said earlier, is remembering the difference. Charts look mathematical, precise, but the market driving those charts is purely psychological. Every single trade isn't just data, it's a vote of confidence or fear about the future of that underlying idea or company.
Beautifully put. It's all about that collective belief shifting. But that ambition, that chasing of growth in equities, it needs a counterweight. Which brings us neatly to stream 3, fixed income.
Bonds.
Okay, bonds. If equities are all about ambition, bonds represent restraint and stability.
So when you buy a bond, maybe a U.S. Treasury bond or a bond from a big company like Apple, you're essentially lending them money.
Exactly. You lend them money, and they promise to pay you back with interest over time. That promised return is the yield. Bonds are like the quiet architecture holding up the financial world. They provide structure.
And this is where the big policy decisions really hit home, right? Central banks.
Undeniably. This is the policy center of the universe. Central banks like the Fed operate directly here, setting the short-term interest rates that effectively dictate the cost of money globally. The rest of the market listens very carefully to what happens in bonds.
It's like the financial system's center of gravity.
That's a perfect analogy. Inflation, interest rates, the big economic cycles, they all exert their pull through the bond market. It sets the foundation.
Okay.
And critically, the bond market doesn't just react, it anticipates. Think about the yield curve.
Ah, the yield curve. Sounds complicated.
It can seem that way, but the basic idea is simple. It just plots the interest rate, the yield you get for lending money for different lengths of time. Short-term debt versus long-term debt.
Okay, like lending for 2 years versus 10 years?
Exactly. Normally, you expect to get paid more interest for locking your money up for 10 years than for just 2 years. So the curve slopes upwards.
Makes sense. More risk, more reward.
Right. But sometimes that curve inverts. It bends the wrong way. Short-term rates actually go higher than long-term rates.
And that's bad.
Historically, it's been one of the most reliable predictors of an economic slowdown or recession. That inverted curve often shows up before the stock market tanks or unemployment starts rising. The bond market smells trouble first. It's like a financial seismograph.
It anticipates the turn.
It moves first, yes.
But let me challenge that slightly. Sometimes you see the stock market hitting all-time highs, seemingly ignoring the Fed raising interest rates. Doesn't the bond market get ignored sometimes in the short run?
That's a fair point. It can seem ignored in the short term. Stock markets can run on euphoria, on, pure momentum for a while.
Right.
But bonds operate on mathematical certainty. A bond contract is a legal promise to pay. The bond market is pricing in the long-term reality of those interest rates, of inflation, of policy commitments. Stocks might be focused on next quarter's earnings.
Well, bonds are looking years ahead.
Exactly. And eventually, that reality, priced by the bond market, asserts itself. Gravity always wins in the end. When the correction comes, the bond market's pricing dictates the terms.
Okay, point taken. It's the ultimate reality check. Gravity wins, so that leaves one stream.
The final stream. Stream 4. Commodities. And if bonds are stability, commodities are the market's raw nerve. This is the stream of pure survival.
Survival, because we're talking about gold, oil.
Gold, oil, copper, wheat, natural gas. The basic physical stuff that civilization runs on. The raw inputs.
Right. Things you can actually touch.
And because they deal with physical supply, physical scarcity, and frankly, basic human needs, they react instantly, often dramatically, to real-world physical events, geopolitics, environmental shifts.
So commodities react first to things like weather, a drought hitting wheat production, or a war disrupting oil supply.
Absolutely. Weather patterns, war, sudden policy changes like tariffs or export bans, and, very importantly, surprising inflation readings like the CPI.
CPI, the Consumer Price Index. How much we're paying for stuff.
Exactly. If CPI jumps unexpectedly high, it signals accelerating inflation. What does that mean? Rising input costs for businesses, the copper for wiring, the oil for transport, the grain for food.
Which means central banks might have to react, hitting bonds.
Right. But the commodity price often moves first, reflecting that immediate jump in the cost of survival, the cost of basic inputs.
And you said fear and greed are the main actors here, more so than other markets.
I think so. Supply and demand obviously set the basic stage, but because commodities touch on such fundamental needs, energy to heat homes, food to eat, the price swings can be heavily driven by fear of scarcity or greed for profit when supply looks tight. It's primal.
And they reveal the system's weak spots, too.
They really do. They show the breaking points. Remember when oil prices went negative briefly in 2020?
Yeah, that was wild. How does that even happen?
It shocked everyone. But it wasn't just that demand collapsed because of the pandemic lockdowns. It was a physical, logistical failure. There was literally nowhere left to store the oil being pumped out of the ground.
So storage tanks were full. Pipelines were full. Tankers were full.
Everything was full. So for a moment, the physical barrel of oil was worth less than nothing because you'd have to pay someone just to take it off your hands. That crisis of physical limits, of storage, created a bizarre, historic price event that the market had to reflect.
Wow. Okay, so we've mapped the four streams. FX for necessity, equities for ambition, fixed income for stability, and commodities for survival. We see how they connect to these deep human drives. So how do we actually use this? Why does understanding this synthesis matter, especially right now?
It matters because the market isn't a casino with separate tables. It's one highly interconnected circulatory system.
Right. Not separate games.
No. Trading isn't just gambling, it's participation. Every trade you make provides liquidity, helps define value. But if you only stare at the stock market or only watch currency charts, you're missing the crucial context from the other streams. You see the wave, but not the tide.
And the good news you mentioned earlier is that the old days where only big institutions had the data, those are over.
Completely gone. The playing field, in terms of access to information and trading platforms, is incredibly level now. You, the individual, can trade right alongside the biggest players in the world.
But access isn't the same as insight.
That's the key distinction. The new advantage isn't speed or even just raw data anymore. Technology is everywhere. The real edge belongs to the person who can interpret the flows, who can see the connections between these four streams. Interpretation is rare. Insight is the new alpha.
Okay, so let's walk through a quick example to really hammer home that flow, that synthesis, let's say. The Fed, the U.S. Central Bank, announces a surprise interest rate hike, higher than expected to fight inflation. That's policy. Where does it hit first?
Okay, policy hits stream 3 first. Fixed income. The bond market reacts instantly. Existing bond prices fall because new bonds will pay more. So yields rise, stability is repriced.
Got it. Bonds react. Then what?
Well, those higher U.S. interest rates make holding U.S. dollars more attractive, right? You get paid more. So global investors buy dollars to buy those higher-yielding bonds. Money flows into the U.S. dollar.
Ah, so that strengthens the dollar. Stream 1, FX, reacts to that necessity of getting the higher yield.
Precisely. But now, companies face higher borrowing costs because rates are up. And that stronger dollar makes it harder for U.S. companies to sell their goods overseas. Their exports become more expensive. ambition gets dampened.
So future profit forecasts might drop, which hits stream 2, equities, especially growth stocks that depend on cheap borrowing.
Exactly. They often get hit hardest. And finally, those higher interest rates are designed to slow the entire economy down to curb inflation. That means expectations for future demand for raw materials, oil, copper, industrial metals might fall.
Pulling down stream 4, commodities, the survival stream adjusts to expected lower economic activity.
You see the chain reaction. Policy shapes bonds. Bonds influence currencies. Currencies guide liquidity and impact equities. And the overall economic outlook affects commodities.
It all flows together.
That's how the system breathes. The goal here isn't just to react to the latest headline about stocks or oil. It's to understand these connections so you can start to anticipate how a move in one stream, especially in bonds, the gravity will likely pull on the others.
So, stepping back, the market is really just a giant mirror, reflecting our collective beliefs, our necessities, ambitions, need for stability, fears about survival. It's not necessarily reflecting objective truth.
Not in the short term, no. It reflects belief. And to navigate it, maybe even profit from it, you have to learn to read that code, the interplay of these four streams. You're essentially betting on how the future, driven by these deep human instincts, is going to surprise the present. Because as we said,
financial gravity always wins, eventually.
That was a really powerful way to start, I think. Unpacking how global capital actually functions, not as random chaos, but as this readable four-part system, and grounded in instincts we all understand.
Yeah, definitely a lot to think about there. Appreciate you tuning in for this first deep dive in our new Macro Fundamentals series. Please join us again on the Financial Source podcast as we continue building your understanding piece by piece.